Hey, everybody. Welcome to this episode of Think Business. Looking forward to talking with Jeff Kamys again. Jeff, it's great to connect with you. You were on the show a couple months ago, and it's good to connect with you again. You've got decades of experience in the technology industry as well as the analytics field. You're the founder and chief investment strategist and portfolio manager at Inherent Wealth Fund, which is also you're also the investment advisor to the iBET sports betting and gaming ETF, which we'll talk about that and all the kind of the fun things you're doing as the creator, also an owner of Dr. Stats Fantasy Sports. But let's dive into kind of the volatility of what we're seeing in the stock market right now, right? I would think that, different age groups are thinking different things as the Dow is hovering at that 29,000 mark. What should people do and what should people expect for the next 12 to 18 months?
First off, thanks for having me again. I have a little bit of a cold, so my voice is a little bit, just been a lot of travel lately, and you seem to get sick when you travel. Here's what's going on, and I think that, people, really the average investor, the retail investor, the people doing it for themselves or are invested, they're either like so not watching what's going on right now because there's so much negative news you're getting every day about companies. I think, inflation's real. We got there late thinking about it. And, now it's a problem. We're seeing like a 10 handle on inflation. That means 10%, for the price of milk or your vehicle, gas, any of these things. And I think it was pretty obvious if you looked at like the CPI, which is a consumer pricing index, you could see how one of the things that's missed about this is that we actually had deflation going into the first part of COVID. We actually were negative inflation for a period in time. So when you look at the negative inflation plus the normal 2% inflation we should have, we're probably somewhere around 6% in reality because of the negative inflation we had. But I would continue to see interest rate hikes from the Fed probably until half of next year. And then I would not be surprised if we had an interest rate cut in the second half of next year towards the third quarter. I think it's gone too far, too fast. And I think that it's going to hurt a lot of, it hurts really the common people who are paying more for gasoline and just prices of everything. I think we have seen some peak inflation though, in terms of goods. The problem is if you look at the inflation right now because of what's going on in Ukraine and because, really what the current administration's, their policy on energy, which is not helpful for oil, has created that last hurdle in inflation is all in energy because everything's in energy. So if you look at, a bottle of beer or a piece of meat that you buy at the store, there's a bunch of energy as an excise tax in that. And so that's really the last hurdle of inflation. I do think most of inflation's come under is restrained. Now we'll be back at a 2% level of inflation per year again. But I think that this last energy hurdle with what's going on in Ukraine, obviously, and Europe, needing things like natural gas is really causing this last hurdle for inflation.
Yeah. Let me ask you a question. Thanks for that. And so, how should people be thinking about a couple tiered questions? How should people be thinking about saving? What do people do about their expenses? And how do you budget differently in a market like we're in today, probably through mid to end of next year?
Well, honestly, I think what we had like this summer is a lot of revenge travel. People had vacations, things planned. I don't think we're going to see that going forward. I think people are going to cut some of the luxuries, things that they don't need. Vices will stay. People will still go and, enjoy some alcohol or a beverage, an adult beverage. They'll do some of those things that are pleasurable, but they may cut down on things like vacations and trips right now because those are the way, you would cut. You don't need it. I mean, obviously everybody pays their rent. You pay your insurance, you pay your health care first, and then you cut down on luxuries. And that's what people are doing. The real problem right now is the market is telling you to not invest, right? Because it's scary. But in fact, this is the time when you have to invest to do anything about inflation, because if you're getting inflation at 6 to 10%, and we can vary that based on, what you think about the deflation I know that we had in 2020, but you're not going to be able to make that back with interest rates or anything else. So you're technically going to be losing 6 to 10% while doing nothing, being in cash. So you have to maybe, stay in your investments. If you've already dropped now and we're down 22, 23% in the S&P 500, 30 to more in NASDAQ, you kind of have to stay there because your only way you're going to make back anything in inflation and baseline your output is to stay invested, because those are the investments that you can have that can return what inflation is producing right now.
Yeah. But thank you for that. Let's talk real quickly about the housing market. I read an article this morning that kind of said that the new norm of interest rates for a house may be 7%. And we've seen people over the last couple of years refinancing in the twos, and then it quickly went from the threes to the fours to the fives to the six to the sevens. What does the housing market look like in the next 12 to 24 months from your perspective?
First off, and thanks, John. That's a good question. And I think what you're going to see, number one, is less turnover, because you're not going to be able to get another mortgage. If you have a 2% or 3% mortgage, you're staying in it.
Right.
You're not going to go and look for new properties to buy at 7%. I mean, I just saw my mom, and we were joking about how in the 70s she had a 12 and 13% mortgage, because that's where it was. We had really high interest rates where you can go, the days where you can go to a bank and get a CD for 6 or 8%. Those are the old days. We haven't seen that in 25 years. But when you think about it, it's going to create less turnover. People are going to be buying less. It's going to create I don't think being in this, I built a piece of software in the 2008, 2009 that had to do with Dodd-Frank, which was essentially like a firewall software where it didn't allow the people who the homeowners were to talk to the appraiser. And what this has done now is it's protected the cap value of a house, because in the old days you would be like, hey, get me the appraiser who's going to give me $1.2 million on my house. Maybe it's only worth $1.1 million. Well, that's not going on anymore. I can tell you that, from my information, which is firsthand because I was in that industry. I think that it's safer. I think people who are saying we're going to have the collapse of 2008, 2009 don't really know that industry. I think it's a statement you can make, but I do not see that coming, because I know that the regulations have been in place, and I know that lenders are not able to do the same kind of loans. I think they're pushing to it. We're seeing a lot of 2 and 3 year ARMs again, but they're at different rates. But I think it's more protected. We're not going to see the default rate we saw before. But yeah, real estate's going to slow down, and you're going to see pricing drop because it makes sense. So think about it. On a $1 million mortgage, and I live in California, so that's a number to use. Yeah. If I had a 3% interest rate and now it's 5%, I'm paying an extra $2,000 per month. Now that's a lot, and that's not even what it is. It's more like 5%, right? So if you're paying 3 to 4% more, that's $4,000. That's almost like having another property. Yeah. So, you're not going to see as much turnover, number one, because people aren't going to have the incentive to sell, because what are they going to go into? They're going to go into something more expensive, unless they're, cash purchasing or something. But interest rates are definitely an issue, but I do think we're going to get relief. I think that this is classic Fed, where they've gone too fast. They're going to continue to buckle it up because they know that's the feeling, and that's going to create, less consumer demand, because people are going to be tighter with the dollar, and you're going to see interest rates then get cut to stimulate the economy again. I don't think this is going to be till third quarter 2023.
Yeah. That's your question. Yeah, I just want to comment real quickly. Going back, I was in commercial real estate in 2008 when the market crashed, and what I talk to when I'm talking to clients in the real estate space is, at that point there was no debt. I mean, everything became cash. There's still money today. It's just a little bit more expensive. And so just
absolutely
the buyer's underwriting have changed. And so I agree. I don't, not that I'm an economist. I'm not. I'm just a business coach who walked out of my LSATs and failed every pre-med class I took. But
I took that too. I took the LSAT too. By the way, I never became a lawyer, but I did take that.
Yeah. But I just, to me, they're two totally different markets. Let's talk about some of the things that are hidden expenses for people. All the $9.95 and $4.95 and $16.95, subscriptions you have. I think this is a good time for people to determine kind of like, hey, pay attention, raise your awareness a little bit on those, because I know people could be spending up to $12,000 to $24,000 in just monthly small fees.
Well, right. And one of the things that I would talk about, like, is investing, and where I was concerned about, these, all the essential, the new kind of streaming packages, is that I believe that people would start cutting those because they're excessive. We don't need 12 of them. You may need one that replaces your regular cable TV, but you don't need 12. You don't need Amazon Prime, Netflix, Disney, Hulu, all these other ones. And a lot of people have many of those. And I would say, from savings, and just as like the financial advisor, go dig out your credit card statements or anything you're using to pay those on a regular basis, your ACH or debit. And I did this myself, and I was like surprised. I was like, Oh, I didn't remember when my kids were with me and they wanted the Xbox Live and it was on my account, never being used for 2 years.
Yeah.
It happens to everybody. I mean, it's hard to remember. Like in the bat of an eye, you're like with somebody and you're like, oh, let me get that because I'm going to get that movie. But then you really don't want the service, but it stays on your account forever. And those auto renewals are a nightmare. So I would say just a simple tip: spend about 20 minutes and go through your credit card statements and your bank statement just to see what you're paying for and reduce what you don't need, because you don't need all of that. I mean, I'm somebody who's a firm believer, just Netflix. Let's talk about that as an investment really quickly. Yeah. I think they should have had a TV channel package a long time ago. I don't understand why they haven't built that in. It doesn't make sense to me because people don't want to have 50 things to remember. They want to go to one place for something. So, I would say that's a great place to cut any of those recurring charges. It's so easy to forget that you're paying them, because they are minimal, but they add up.
Yeah, no, I love it. Let's talk real quickly about, you're in the wealth management space, and then you're also in this very cool, fantasy sports, world that you live in. And one of the things that I always find fascinating is, well, first, let me just say, you took kind of your years of sports analytics and moved it into the stock world. But it always amazes me how these brilliant minds can, create a spread on anything. And it's remarkable. It's so moneyballish, like looking at the stats and the numbers to come up with the numbers. How do they do that?
Are you talking about in the market, or are you talking about it just in terms of games?
Just in terms of, I'm out of the market.
You're talking about betting. You're talking about betting.
Betting, yeah.
So here's what used to happen, right? There was this is like in the 70s, pre-technology and computers. So it used to be like 10 or 12 guys who were, sharps. Sharp is a term for a guy who wins, who understands betting lines. Yeah. And they would just go, Sunday night after the games ended, or Monday, they would they'd go in a room, they'd all meet for like an hour, and they'd just start betting until they felt it was fair. So that's how they developed the line. He'd be like, oh, I'll take Green Bay. I want 3. And the guy goes, oh, 3. Nah, I'm not going to bet it. And then they would just exchange to like just making a market, right? So you say it's worth 10. I say it's worth 7. Maybe it's worth 850. It's no different. Yeah. It's so market economics. There's no better place. It's the exact same thing, right? People will buy until it goes the other way. Then they're selling, because they feel like it's been overvalued. I think it's a great way to look at gaming. We have something called RSI in stocks, which is relative strength. And it really dictates whether something's overbought or oversold. Like in the market right now, we're totally oversold. But that doesn't mean people are going to run into the market just because it doesn't feel great right now. You may get these technical bounces. We're getting one today in the morning, sold off. And then we got a technical bounce back up just because it's a bunch of algos going off. Yeah. But when you think about betting with sports, I always think about this. I think about, there's a perception that comes in that loads a bet up, but maybe that team really isn't that good. And the team that's lost, maybe they've lost a bunch of close games and the perception is they're terrible. So when you look at from that point, sometimes a team is too much value and a team is too much undervalued. And those are things I look for in betting myself. And I enjoy betting on games, I bet on the NFL. That's pretty much all I bet on, but I do enjoy betting on it as well. And I look for that. And you'll find it, the old way to find that was when a team hadn't covered like 3 or 4 times in a row, you'd look to bet on that team because at that point they become, oversold. And so they're getting more value, maybe more points. So that's something I'd look for your audience that is into handicapping.
All right, good. I like it. All right, Jeff, you ready for a quick speed round?
Speed round.
Since we last spoke, book that's had the biggest impact on you?
Oh, I just think, community and friends and getting to know people and being open about the world and opportunities. I think that's where I always try to stay. Despite any kind of setback, you have to stay open to things.
All right, good. Best piece of wisdom you've ever received?
I mean, it's simple, but don't stop and don't take failure.
Yeah. Finish this sentence. If somebody is freaking out about the markets and they're 75 to 80 years old, something they need to do is
get a new advisor because they don't have the correct strategy for their age.
Okay. All right, good. Tell people who your ideal clients are, Jeff, and how they can connect with you.
My ideal clients are people who need help. I work with teachers. I work with all kinds of people. So executives, whatever, and just people who need help, who want to entrust someone who can give them a little bit of an edge and can give them some calm and not have to worry about the stock market. But you can get in touch with me. You can Google me, Jeffrey Kamys. You can look the iBET Sports Betting and Gaming ETF up, or Inherent Wealth Fund.
Yeah, Jeff, I always appreciate connecting with you, and thanks for your guidance today on how to kind of look at the market. One last question: should people be worried?
No, you shouldn't be worried. This is, when people start getting worried, that's when actually you should start investing. And when you get this capitulation, which means that everyone's thrown everything out the baby with the bathwater, not an expression I use a lot, but that's the truth. When you get that way, that's kind of like this whole thing, we've given up. That's when there's opportunities. And if you were in commercial real estate, John, in 2008, people with cash made a lot of money.
They made a lot of money.
They made a lot of money because they stayed convicted, because they know the world's not ending. We're still going to be here, and so you got to stay focused, be long-term in your mind. And that's how you overcome it.
Yeah. Well, as a business coach, many of my clients, and I see this all the time, this is the time where they grow their business in a significant way. It's a time where, and I work with solopreneurs to fortune companies, C-level execs to salespeople, managers. This is the time to double down. This is the time to get hyper-focused, grow market share, grow mind share, ramp up your metrics, and really, really focus. These are times where people who wouldn't meet with you in the past or talk to you will today. Everybody's trying to figure it out. So to me, my consistent message is always double down, right? Double down, because in markets like this is where, in adjusting markets, you can really, really grow. If you're going to the sidelines, then you're gonna wake up in 12, 18 months and really be behind. So
you're 100% correct. This is when innovation happens. It's for disruptors.
Right.
It's a time when people have to look at new products, new things, new directions. And, let's face it, there's blood in the streets for investors and what's going on in the market. So that means there's new ideas. There's people who are going to look for a change. Somebody said to me, they said, it must be bad time to be an advisor. I said, no, there's a lot of people now who are going to be looking for change.
Yeah.
And if you're a change maker, that's a great opportunity.
Right. And in your market, I think the retention fee is somewhere like 96, 98%. But you're right. This is the time when people say, well, I'm not getting the calls or the follow-up or the feedback that I need. And they're open to discuss. It's interesting. I kind of felt this coming. So in about, I think, 2 weeks, I'm launching 4 on-demand courses. So for people who may not have the investment for one-on-one coaching, they can take, an 8-week class, on-demand class that I have, or an online sales class, or I wanted to be innovative for people who needed coaching, but maybe didn't have the dollars or the investment to make for a custom one-on-one or keynotes or things of that nature. But you're right. It's time to be innovative and think forward. So
I think that's great for the coaching. And I think that's a great way for people to get into your program, to maybe get that connection with you, to learn some of the sage advice you have after all your experience.
Yeah.
But you're right. The way you're thinking is exactly how it should be thought of.
Yeah.
When it's competitive, people don't change. They stay. When things are going fine, people don't look for change.
Yeah.
And I would say one of the things you mentioned about the 97% retention, people need to be a little bit more attuned to what they're dealing with in terms of their investments. And I always preach to them, like, you're not looking at it. You need to look in, and funny, I just saw my ex-wife. I'll tell you really quickly. And I said to my ex-wife, she showed me her portfolio. She had some money invested with an advisor. And I said, Deborah, you could be doing that yourself. There's nothing in there. There was no type of hedging going on. There was no defensive positioning. And I said, why are you paying him whatever you're paying him to do that? And, I kind of empowered people. I always, as much as it's my industry, I do want people to be empowered by the knowledge. There are more complicated things we do as well. But most people, like in the case of my ex-wife, she was having someone manage something for her that she could simply do herself. There was nothing great about it. So people are afraid because it's new. We made up a bunch of confusing language in the stock market that people don't understand. But most of it really simple. If you like a company, invest in it. If you believe in it long term, understand your time horizon. Know you should be more defensively positioned if you are older, maybe more in things that are fixed income. Yeah. And make sure you're comfortable with the risk you're taking.
Yeah. I love it. Jeff, it's always a pleasure connecting with you. Tell people where they can connect with you one more time.
Yeah, you can look me up, Jeffrey Kamys, Inherent Wealth Fund, or the iBET Sports Betting and Gaming ETF. If you Google me, I'm on podcasts like John's, many of them. You'll find me somehow.
Awesome.
I'm ubiquitously everywhere, unfortunately, but it's fine.
I love it. And think community, if Jeff can help you, it's Jeffrey, is I'm going to spell his last name, Kamys, or you can reach me at johndwoskin.com. Jeff, always great. Always great. We'll see you again in maybe a couple months.
I appreciate it. Thanks, John.
Thanks so much.
Bye-bye.